What do you do when the risk of a bubble is elevated, but you don't know when it will end? That's the problem investors are facing today. Valuations are stretched, market leadership is narrow, AI is driving a huge share of enthusiasm, and a lot of investors who own the S&P 500 or the Nasdaq today are more concentrated in that theme than they may realize. But trying to call the top is nearly impossible. So the real question is how to keep participating without becoming too dependent on that one area of the market. I'm Rasa Tefi, founder and senior wealth advisor of Yatra Wealth Design, and in this video I'm going to walk you through my newsletter, How to Invest During a Bubble, and explain how I'm thinking about that trade-off. So we'll discuss the high-level framework of how to handle the current environment, why bubble risk today is elevated, the timing problem, the lessons from the late 1990s internet and tech bubble, and finally, a more detailed explanation for how we're helping our clients navigate this bubble today. So let's dive in. So as I mentioned, the high-level framework, we'll start with that, is that, investors today, we don't need to predict the top of the bubble. But we should look at what's going on and some of the common threads of past bubbles and see how they apply to today's market. So currently we see high and record valuations. We see very high levels of concentration. We see narrow leadership within the market. And we have an investor psychology on average that's very speculative and very optimistic around AI and technology today. And so the probability weighted risk of being in a bubble today is, certainly elevated relative to history. The right answer today is not to panic. It's not to go all in or all out on the bubble area of the market, but it is to kind of understand, number one, how much risk you're taking and how much exposure you have to that area. Number two, to participate to some extent and whatever extent makes sense based on your goals, your comfort level with risk, and your long-term plan. So again, to participate, but don't become dependent on the bubble continuing and those areas that have been doing the best to continue going up, and build your whole financial life around that assumption. So let's get into more detail here, and we're going to start with why today deserves the bubble question in the first place, right? So what are we seeing that is causing us to be more concerned? So as I mentioned, bubbles have happened throughout history, many times in the past, whether it was the internet bubble in the late 90s, maybe it was the housing bubble in the mid 2000s that ended in 2008, 2009. We had a bubble because of the railroads. There was a giant bubble in Japanese commercial real estate. There was a residential real estate bubble in China that's just sort of being dealt with today. We had something called the South Sea bubble back in the 1700s, I believe, with Isaac Newton being a participant in that. So I mean, you can go back and see many different bubbles throughout history in the financial markets. But frankly, I mean, bubbles just happen even in day-to-day life. Like, I don't know if you remember when the Beanie Babies were extremely popular, and some of those Beanie Babies were selling for crazy prices, right? I mean, that's almost like a miniature bubble within that world. And it comes from, how does a bubble form? I mean, it comes from first a lot of excitement about whatever's going on in the financial markets. That tends to be some sort of new technology and optimism around that. And then, the awareness and excitement around that starts to grow broader, and then the investment dollars start to flow in. And then the price of those assets starts to go up. And as the price goes up, then more and more people start to take notice. And it almost becomes a self-fulfilling prophecy for a period of time where the more that the price goes up, the more people hear about it and get excited about it, and then they start investing in it. And it builds and feeds on itself, and you can really see prices go pretty crazy, and the optimism go in many cases way ahead of the reality of the technology itself. So it started with something real. Obviously the internet was real, and there was a lot of things that we have today that came from that. But the optimism around how quickly and how significantly the changes and frankly the profits would be got way ahead of itself. And so we had that bubble in the late 90s, early 2000s. And I know it's a silly example, but the Beanie Babies, that's a good example where the bubble built on itself. A bunch of people got into buying those that, would have never bought Beanie Babies if they didn't think that the price was going to keep going up. And then eventually that bubble burst, and prices came way back down to a more normal level, right? So we have to just acknowledge that throughout history and just human nature, we have these bubbles and then these bubbles bursting. So we're going to look at, first, like, what are some of the, historical corollaries or things that are common amongst bubbles, and how does that relate today? So we oftentimes see very high valuations in companies, in the markets. We see narrow leadership, so just one concentrated area typically that's going up, or a few companies that are going up a lot. A powerful narrative. Obviously we have the narrative around AI today. High and increasing concentration, where smaller and smaller number of companies are doing really well. And then investor psychology that becomes more and more speculative. And I would say there's no doubt that we have that today, and I'll touch on a couple of those in more detail here. So this is one valuation metric called the Shiller PE ratio, and it looks at S&P 500 profits over the last 10 years and adjusts those to inflation. And what it's good at is kind of smoothing out profits, because sometimes profits can become too very high temporarily, at the peak of a business cycle or the peak of a bubble, and then they can also become way too low, let's say after a recession or something like that. So this gives you an idea of over a longer period of time, are valuations high or are they low or sort of in the middle? And you can see that today, based on this metric, we're at almost the highest, number we've ever been at. The only time it was slightly higher was right at the peak of the late 90s internet and tech bubble, before it burst. And this valuation ratio is extremely bad at predicting what's going to happen over the next 6 months, 1 year, even a couple years out. But it's very good at telling you what your likely return will be over the next 5 and certainly 10 years, right? So if we're at very high valuations today, some of the highest we've ever seen, that doesn't tell us what's going to happen over the next year, but it does tell us that we're buying at a price point that is very likely to generate low or even negative returns over the next 5 to 10 years. And I can show you that here. So this is showing that if you buy into the CAPE multiple of 35 or above, and I believe we're at 40 today, historically speaking, right? Obviously doesn't mean that's going to for sure happen going forward, but historically speaking, if you bought at these level of high valuations, you would have seen negative returns over any longer period of time. So that's the concern I have in these high valuations. We can also look at the price to revenue multiple on the technology index. So for all the tech companies, how many times revenue are we paying today? And you can see that metric is even higher than it was in the late 90s, early 2000s tech bubble at the peak. So for every dollar of revenue today, you're paying 10 and a half times that plus for the technology companies. And again, historically speaking, that's extremely high, and it's pricing in something, a lot of optimism, which is that, revenue will keep growing at a really fast pace, and then also that revenue will turn into sustainable cash flow and profits. And if any of those assumptions doesn't quite meet up to expectations, the concern is that you can see a huge downward move, and that's what we saw in the late 90s, early 2000s bubble. So again, we don't have any crystal ball, but we can look at the probabilities at some of these metrics here, and at least determine that the risk of a bubble is much higher than historical norms. And there's also the narrative, right? The narrative around AI has become a bit extreme, I would say. I mean, it's basically that AI is going to transform the world in a very short amount of time, and it's going to generate humongous profits for the companies that are a part of that. And again, that may happen, right? I mean, I can't say for sure. I do think AI is a real technology. It will have real benefits and transformations on society. But the level of optimism that's priced into markets today doesn't leave a lot for error, a lot of room for error, right? So with that said, I think it's safe to say we can acknowledge the risk of a bubble is higher than normal. With that said, we don't know, right? That's the timing problem here. We don't know when it's going to end. But I like this image of someone riding a bike down a hill, and I like that because I think it's a great analogy. So if you're riding a bike down a mountain and it's going steeper and steeper, your risk of falling is going higher and higher, and also the consequences of falling are going more and more intense. Meaning, if you do fall, you're going to get wiped out and potentially seriously injured. Well, what most people do, I think the intelligent thing to do is to slow down, right? You might make it to the bottom without slowing down, but if you do wipe out, right, you're going to get seriously injured. So the smart thing to do is to slow down. Not to stop, not to, turn around, right, but to slow down. And I think that applies to a bubble. It's that, we don't need to get all in or all out of a bubble. But as things get crazier and crazier, or more concerning, we should start to slow down and potentially continue to slow down. So we're going to talk more about that. So again, that's how we kind of solve the timing problem. It's that even if we do have concerns that we're in a bubble, we don't know when it's going to burst. So we should slow down but not stop. Now, this is a little bit of lessons from history, and I think this is probably the most analogous to today, which is the late 1990s internet and tech bubble. And you can see that the chart here is really a good thing to look at. So let's say the bubble started, and and the optimism around the internet and technology got really going in '96 and '97. But you can see, looking at the chart here, that the real returns, the real rapid returns, didn't even start until, let's say, 1999. So maybe if you identified that we were in a bubble in '97 or '98, and you potentially were concerned about it, but then the market kept going up, and it really started to go up the last couple years of the bubble, you could easily get shaken out of your concern or your position and kind of jump back in, which a lot of people did, right? So people, I thought it was a bubble in '98, got worried about it, maybe even exited their positions, but then the market went up so much so quickly over the next couple years that they kind of got sucked back in. And then when the bubble burst, it fell, over 80%. And so a lot of people that were investing in the last couple years of the bubble, they not only lost their gains that they had made, but they also lost a lot of their principal, right? And so I think a better strategy than, continuing to increase your, holdings in the bubble, area, or the areas that we think might be a bubble, instead of increasing that as things go up and up and up, it's actually to kind of either keep your percentage that's in, let's say, technology the same over time, which is going to mean sell some of your gains over time and diversify, or maybe even decrease your percentage exposure depending on how much you have at any given time. So if you started, if you started in technology before the bubble started with 25% in tech, and then it went up to 50% because it did so well, well, maybe you should at least, come back down to 25%, right? And, if 25% is still really high, depending on your risk tolerance and your goals, you might even start to go down further, right? Maybe drop to 20% in 1999, and then, 15% in 2000. And so, you're still going to have exposure at the peak, and you're going to see some hit to your portfolio when the bubble bursts. but you'll have captured a lot of gains on the way up. And then when the bubble bursts, and if there is a major downturn, you're not going to lose all the gains that you saw during those years, right? And your portfolio will hold up a lot better than if you had just increased exposure over time. And so that's the idea, sort of like lessons from history. It's also a psychological, lesson because just like Isaac Newton experienced. So this is a great example. Isaac Newton, he was alive during the South Sea bubble, and reportedly he invested in the South Sea bubble. He made a bunch of money, and I think at least doubled his money fairly quickly. And then he got out because he thought it was getting kind of crazy. So he sold his investments in there and got out. But then the bubble kept going, and a lot of his friends were still in it and were making a lot of money, and he just couldn't help himself, so he got back in. And that was kind of like near the peak of the bubble. The bubble burst, and then he lost most of his, all of his gains, and frankly, most of his principal, his original investment as well. And so again, Isaac Newton is obviously very intelligent, but this psychological impact of a bubble, it's so difficult for most of us to deal with. And so again, I think you have to do some of the techniques that we're going to talk about in further down. So yeah, the better approach, reduce dependence on the most crowded part of the market, but don't go all out. Right, so we talked about that. It's maintain exposure, but reduce your dependence, reduce your exposure over time. Two is match your exposure to the risk that you're willing to take. I mean, first you have to understand how much risk you're actually taking if the bubble bursts, and if we have a similar scenario to prior bubbles as far as how much that area can really fall by, and then make sure that the risk that you're taking is acceptable. Right? Potentially reallocate some of those gains toward better risk return areas. So, today, just like in past bubbles, there are areas of markets in the investment landscape that have been ignored because a lot of the capital is flowing to the AI build out right now and the optimism around that. And so there's actually, a lot of areas that you can invest in today that I would say have better risk return potential outcomes over the next number of years, and so because of that, and a lot of it is because they've been ignored, and because everyone's focused on the bubble area, right? And that's what happened in the late 1990s, and I think it's happening to today. So looking out for those areas to diversify into is a good strategy. And the best example of that is Warren Buffett. He did that in the late 1990s. He basically stayed out of the internet bubble. And for a few years, people were saying, he's lost his touch. He doesn't understand technology. He was underperforming. But he was buying kind of like regular boring businesses, insurance companies, banks, etc., at great valuations at the time. And then when the internet bubble burst, his portfolio did really well, and the capital rotated into more of those, traditional businesses. And then suddenly, everyone remembered, oh yeah, Warren Buffett is a great investor, right? And so, I'm not suggesting that you take that approach because I think it's really difficult to just stay out completely. I do think participating to some extent is a good idea, just at least for the psychological aspects, because we don't know how long it's going to go for. But we should also take some lessons from that, in that you can do really, really well in your portfolio without having to invest in the bubble, right? We just want to take a longer term, bigger picture approach. And then keep the portfolio connected to your plan. So what is this money and investments really for? Is this for your retirement and income in retirement? Is this for helping your kids with college? Is this for buying a new house? Is this, just for financial security? Whatever it is, you need to just kind of remember what the money is for. And so, you may decide like, hey, I have X percentage that I'm very comfortable speculating with, and even if it dropped significantly, I would be okay, and my goals wouldn't be impacted by that. Then I think that's completely reasonable if you really believe in the AI build out, and you don't think there's a bubble. I think that makes sense to that's acceptable to kind of speculate with. But you want to understand how a potential bursting of the bubble would impact your portfolio and if it would actually impact your ability to achieve your goals. Because if it would, then you should probably consider making some of those adjustments we talked about earlier. And that's again, it's not panic and it's not prediction, it's just process, right? And that's what we do for our clients on an ongoing basis. And so, yeah, what have we done? I mean, basically what we've been talking about, we've been helping our clients to consider all these different aspects, participate, but slowly, diversify further and further, make sure that we're taking the right level of risk based on their comfort level and goals and financial plan. And the final takeaway here is that no one knows when the bubble is going to burst in advance. No one can time that. But we can recognize when the risks are elevated as they are today. And we can understand what the risk would be to some extent of if the bubble was to burst, and how that may impact your portfolio and also your ability to achieve your goals. And I think in this current, environment and in any bubble, there's a lot of optimism and a lot of excitement and a lot of FOMO that people can experience. But taking a bigger picture, longer term view can really help to protect you from getting sucked into the bubble psychology. And so that's what we would suggest doing. And if you're interested in learning more about this or having some perspective on how you're currently investing or tracking towards your goals, we'd be happy to discuss with you. I hope this is helpful, and take a look at this newsletter if you want to see more detail on everything we discussed. Hope you have a great day.